Hello and welcome to TS's Finance Nuggets. In today's video, we're going to be talking about trading costs and fees. Trading costs are basically costs incurred when transacting in the market by investors and traders. And there are different types, but first let's start with brokerage costs. It isn't really applicable today as most traders and investors just use one of the many online stockbroking accounts. But in the past, stockbrokers used to charge a flat fee for every trade transaction, and this is brokerage cost. Next, we have the bid and ask spread. This is the price at which you can buy and sell a stock at the same time. If you buy a stock and then you decide to sell it immediately, you will lose some money. How much you will lose will be determined by the magnitude of the spread. Next, we have price impact. How much is the price impact? If you're buying 10, 20, 30 shares, you might not feel it. But if you're buying 100,000, 200,000 and above shares, you will feel the price impact. Because as you buy these large units of shares, you will drive up the price of the stock. And when you sell these large units of shares also, you will push down the price of the stocks. And this is price impact. Another is opportunity cost. If you are worried by the price impact and decide to wait on trading the shares, you might actually get lower returns or not be able to actually trade the shares at all. And that factor should be weighed in somewhere in the process. For the bid and ask spread, there's a market dealer that is charged with the responsibility of smoothing the trading process, and he is also charged with the responsibility of setting the bid and ask spread. The market maker has to cover three types of risk. First is the risk of holding on to inventory, then the cost of processing order, although it's lower than it was 10 to 20 years ago, and also the risk of trading against investors that are more informed than him. So he has to set this bid and ask spread large enough to cover these risks. However, the bid and ask spread varies across stocks, market, countries, and even time, and there are different reasons for this. First is liquidity. Very liquid stocks actually have very low spread, while less liquid stocks have a higher spread. Another factor is who owns the stocks. If the stocks are owned majorly by institutional investors, then the bid and ask spread will actually be higher. Another factor is the riskiness of the stock. Less risky stocks actually have lower spreads, while riskier stocks have higher spread. And lastly, we have the price level. Low price stocks actually have a higher spread when compared to high price stocks. However, the two major variables that determine the bid and ask spread are the price level and liquidity. Also, it's important to note that other asset classes also incur transaction costs. For example, if you're investing in a real estate property, you're probably going to pay for agency fees and other fees that are associated with the transaction. Now that you know the different trading costs and fees associated with investing in stocks, I want you to be on the lookout when investing in stocks or trading and incur as low fees as possible. Thank you for watching, and if you learned something new, don't forget to give the video a thumbs up and also follow at TS's Finance Nuggets. Thank you and goodbye.